Hello, good afternoon, everybody. My name is Solomon Consuegra. I am a home mortgage consultant with Wells Fargo. My NMLS ID, safe ID uh, uh, number is there, 1204342. I have to state that every time I mention anything about mortgages to be compliant with federal regulations. I'm going to be going over some of the key topics and basic topics when it comes to mortgage applications. The way I like to conduct the meeting is as we go along, please refer your questions to Patricia. She'll be more than happy to then pass them on to me, and then I could pause and answer that question. If you prefer to wait till the end of the presentation and ask the questions, that could also work out as well. I'm going to be going at a pace comfortable to me and everyone else. However, if I go over anything a little too fast, please, once again, stop me or say, what was that you said about credit? What was that you said about down payment? And I'll be more than happy to repeat, paraphrase, whatever that case might be, to be able to be effective in the presentation and have you guys understand the information. Once again, that's me here. Let me see. Here we go. By attending this event, you are taking an important step toward your homeownership goals, or whether you're planning to buy something now or in the future. I love to talk to all my customers when it comes to getting referrals from the banks, for example. Bankers ask me, Solomon, what do you want me to ask the customer? How do you want me to screen the customers to make sure they are a qualified referral? Or a quality referral. And I just mentioned, send everyone that remotely mentions anything about mortgages. I'm more than happy to go over any questions they may have, because even if that customer is not ready now, he or she might be able to qualify later. So this event will help you gain a basic understanding of how the home buying and home financing process works, so you'll know what to expect and be better able and prepared to make informed decisions when it comes to applying. We are going to be covering several subjects: deciding to buy a home, which will go into the difference between renting and buying or owning; qualifying for a mortgage when we pull credit and get your income information; the credit basics, which is most important. The credit basics, it's all going to be based on credit, and not only your credit score, but your debt. Whatever shows up on your credit report, auto loans, student loans, mortgages, personal loans, so any other type of debt that shows up there, we deal with that, and we use that to calculate your debt to income ratio. So it's very important you pay attention to that subject. Home financing basics as well, and the home financing process as to what the banks do with your information, how long does it take to get a pre-approval or to approve a loan and such. So deciding to buy a home. This is a very easy slide, basically very self-explanatory, pointing out the differences and advantages or disadvantages of buying and renting. When you buy, your mortgage goes towards building equity in your home, meaning building value or savings equity in your home. If you buy a home, for example, in my case, and I gotta be referring to my case because it's easy for me to point that out. I bought a house 6 years ago for $365,000, and that same house is now worth $650,000. So I built equity. When I pay off my loan, or right now, if I decide to sell it, I have like over $400,000 in savings or equity in my home. That's something you don't get with renting. When you rent, of course, all the money that you pay goes towards the property owner or the landlord. The second bullet usually requires buying usually requires an upfront financial commitment. That upfront financial commitment we will go over in a few slides later. It deals with at least 3% down payment and 3% off the sales price, and an estimated 4% of the sales price in closing costs. So at least a minimum of 7% of the targeted sales price is what you're going to need of your own money in banks or gifts. We'll go over that later. To get a mortgage loan. Kind of the same on renting. Renting usually, especially here in South Florida, they ask for 3 months deposit. But that amount is still lesser than the 7%, unless if we're talking about the median home here in Florida, which was last year was $589,000. 7% of that happens to be like $35,000, let's say. So that's a little more than 3 months of rent, but still the benefits, in my opinion, outweigh to own that than to rent. Buying offers stability compared to short-term leases. Your lease expires on a yearly basis. And not only does it expire, but also your rent increases. Here in South Florida, we have seen rent increases as much as $1,000 going for clients, for customers. They come to me, hey, Solomon, my rent is being raised from $1,500 to $2,500 because apparently there's no rental control down here. So once again, with owning a home, especially with a fixed mortgage rate, you avoid to having anything like that come to create any type of payment shock with an increase of rental like $500 to $1,000 on a yearly basis. Buying also allows you to customize your space any which way you like. You could paint it any which way you want, especially the inside. The outside might be different according to city or municipal codes or HOA restrictions, but at least you can do a lot with your home. You could do the landscaping. You could do just about anything to your own home, as opposed to when you're renting, there's nothing you could do because you need the permission from the landlord or owner to do that. So that's also a benefit. Yes, buying comes with additional responsibilities, such as the landscaping and the home repairs. You're not gonna call a landlord and a handyman to do it for free, and now it's your own. But once again, even if I am to calculate all the money that I have spent on my house over the last 6 years on landscaping and things like that, or anything like that, if I change the floor and such, I have to pressure clean the house every now and then because the HOA requires it. Still, if I make what you call it, a list of all the money I spent, let's say over the 6 years, even if I spend $30,000 on doing things like that, the equity of $400,000 definitely outweighs that amount. Yes, renting, you don't have responsibility for maintenance or repairs. Any questions about that? Move to the next slide. Home ownership is a long-term commitment. You may be ready to buy a home if you have a stable income, pay your bills on time, that deals with credit, plan to stay in your home, and feel prepared for the responsibility. One of the things I like to clarify, especially with younger customers, is that when they think of getting a mortgage for 30 years, 20 years, 15 years, they think that they're going to be stuck with the debt for that long. And that is not the case. You only stuck with the responsibility until you sell the house or whatever the case might be. So I have actually, over the last 25 years, I have owned like 5 different homes on lease, but that's because I was in the Army and I was traveling all over the States for 3 or 4 years at a time. Because I did not want to rent, I was actually buying properties. So I never stay more than 4 or 5 years in any given property I own over the last 25 years, except for now that I made something with my home. So, but once again, you're not going to get stuck with that debt. Once you sell the home, you pay the bank whatever balance you owe on your mortgage, and you're scot-free again. Any questions about that?
There are no questions, but you were kind of cutting in and out a little bit.
I am. Okay, I'm trying to lean forward as much as possible.
You sound okay now. You sound okay now. It seems to come in and out.
I'm gonna move the laptop a little closer to me, and now it's just my face is gonna look bigger, but that's okay. I'll make sure I go to the gym later today. Qualify for a mortgage.
Solomon,
Yes,
I do have a question for you. On the slide, it says purchase home is a long-time commitment. I often run into potential buyers that are interested in purchasing a home short-term. You know, they see a lot of information on HGTV where, hey, I can buy a home, be in it for a year or 2 years, and then flip it and move on to something else. How do you advise that customer or someone interested in doing such with a short-term mindset in their investment?
Well, just like I was saying in my case of being in the Army, because I was moving around, anyone else that has a mobile lifestyle or mobile job per se that involves traveling, they have options to either sell the property or actually rent it. And one of the good things about renting a property you own is to not only offset the mortgage payment with the rental payment, but then that also may qualify you to actually get another loan where you go next. So when I actually was moving here and there with the Army, I actually ended up, not by choice, owning two other properties, one in Kansas, one in Georgia, and actually one here in Florida. So it's actually three homes, and the income from the rental was offsetting the mortgage payments and actually leaving me with a little bit of extra income that I could report to actually buy another house. And that's kind of what I did when I purchased this house. All that have to be taken into consideration. So yes, you could do that. And also in terms of long term, short term, there is the one type of loan that we're going to go over later, which is the ARM, or adjustable rate mortgage, in which you get a low interest rate for 5, 7, or 10 years. That's when you have planned that you're not going to stay there for 20 years or 10, you're going to stay 5 years. I used to get ARMs when I was in the Army, so I would get a lower rate for 5 years, and then I would sell the house prior to the rate becoming adjustable and increasing. So that's one of the options you could do. So you could either sell it, of course, or keep it as a rental investment property and have that income not only offset your mortgage payment, but also might be able to increase your income to actually be able to buy something higher, because now you have more income than your sole salary or income that you have. Did that answer your question?
Yes, thank you, Solomon.
Okay, because if you were talking about any other type of deals, it depends on the stage. For example, there is some type of like rent to own contracts. I don't advise to get into those. I would advise to get some legal advice when you get into those agreements. But like I said, hopefully that answers your question. What do lenders consider, right? Income. Do you have the source of income to make the monthly payments? Everything here on the mortgage application revolves around what we call the debt to income ratio. Debt to income ratio. Debt to income ratio is basically could be 45% to 50%, depending on your credit score. If it is above 700, your debt to income could be 50%, which means 50% of your income. So let's say if you make $10,000 a month, just to use a round, easy metric number. That means we're going to use $5,000 or 50% of that to calculate or to project all the payments that you need to make with that money. Meaning that your mortgage payments and all your current debts, auto loans, student loans, cannot go beyond that 5,000 or 50% debt to income ratio. That's what we mean by that. Do you pay your bills? As far as credit history is the other very important thing. Any type of late payment, it hinders, it damages your credit score. Now, and we'll go over that in some other slides, the minimum credit score for conventional loans is 620. For FHA, it's 640. So when we talk about paying your bills on time, it's just not a matter of discipline or a matter of having collectors harass you to make the payment, but it damages your credit score tremendously. So try to always be on time. Keep an eye on when you move, when you change cell phone providers. If you have any balance whatsoever, even if it is $60 that you owe on T-Mobile, do pay it. Do call your previous service provider, whether it's cable, any type of utilities, to make sure that you don't have any outstanding debt, because even if as little as $50, $60, and I see it all the time, could damage your credit. You might not get a letter from T-Mobile or from your utility provider saying, hey, when you close your account before you move to your new neighborhood, you forgot to pay the balance of $60. You might not get that. You might not get an email, but you would definitely gonna get a collection agency that's gonna damage your credit. So keep an eye on that. Your credit history, that's basically the same thing. Your credit score, I went over that. It needs to be a minimum of 620 or 640 for FHA. So I always tell customers, try to have it at least at 700. That will give you an optimum debt to income ratio of 45% and also a better interest rate. The outstanding debts basically refers to the calculations we make to the monthly payments you make. So whenever I talk about a car payment, student loan payment, what we do is we add that amount and we add it to the projected mortgage payment to come up with your debt to income ratio. And that number has to be below 45% or 50%. Otherwise, we have to lower the loan amount so that the numbers actually fall within those limits. Any questions about that?
One question came through. Megan says, not sure if it's true because it seems insane, but how are you fielding the increased interest rate for those with higher credit scores and a decrease for those with a lower credit score?
It all deals with risks. That's something that is not done manually by me or anyone per se. Is an inherent. It's kind of like the same algorithms that are used to calculate your credit score. What the mortgage application uses something similar to assess risk. So if you have a lower credit score, and customers, believe it, don't like to hear that. And there have been customers, for example, in our case, bank customers have been loyal bank customers for about 20 years with Wells Fargo. And when I mentioned, well, your interest rate is 6.5 because your credit score is low, you represent a higher risk of the bank. They don't like to hear that, but that's basically the answer. When it comes to credit score, it assigns a certain credit risk coefficient that will affect not only your debt to income ratio, but also your interest rate.
Megan clarified that she was talking about a new government recommendation.
Yeah, the new government recommendation, I'm not going to go into that because that has been actually in effect since January. It's just that the media put it out over the last 2 weeks that if you have an excellent credit score, you're going to have an extra cost to it. There's always a cost to the interest rate that is represented in what we call discount points. That's something that is not really covered on the slides. I could go over it a little bit. But basically, a discount point is a certain charge at closing cost that you will pay for a interest rate if you choose to get a lower interest rate than the par rate. The par rate, for example, let's say your credit score is 700 and your interest rate is 6.25, but you want to get a 5.5 interest rate. Yes, you could get it, but then you're going to pay what we call in the industry discount points, meaning getting the interest rate at a discounted or lesser rate, and you have to pay a fee, and those fees are called discount points, and they translate to 1 point is equal to 1% of the loan amount. So I know what they're referring to, but once again, it makes no difference what my opinion is about that, whether it makes sense or not, but that's what it is. But that's always been there. Everyone always pays. If you want to get a lower rate, the interest rate comes at a price. So you either get it at a zero charge, at a credit to you if you want to choose a higher rate or interest rate, that is, or if you want a lower rate, you will pay discount points. So with that new regulation, I think 1/8 has been tagged along as a credit to lower credit holders and as an additional charge to people with higher credits. But it's actually, I could say, irrelevant because it's 1/8 or 0.125% of the loan amount. But that's always been there, just that they made some adjustments. There were probably internal adjustments all the time. It's just that this time was kind of overblown and put out in the media.
Thank you so much. No more questions.
Okay, so the assets available are also very important. I like to point out the assets topic when we talk about, for example, whenever I say to a customer that one qualifies for about 5 times what you make a year. Let's say you make $100,000 a year, so that means that you should qualify for a $500,000 loan. But in order for you to qualify for a $500,000 loan, remember that I said you're going to need at least 3% for down payment and 4% for estimated closing costs. So that's 7%. 7% of 500,000, I believe, is $35,000. So you're going to have to need at least $35,000 of your own money or a gift from a parent or a sibling or a son in order to be able to have the loan approved. And it happens every now and then. I get a customer say, hey, yeah, I make this much money, but I don't have any money saved. Well, the answer is then save some money. So you have at least 7% of your own money. Or I go over the subject of if you have parents that could also give you the monies as a gift, that's also a way to actually come up with the additional funds needed. Additional funds for reserves may be needed. That's when it deals with investment properties and for jumbo loans. Jumbo loans, later I'm going to explain, is any loan that is in excess of the amount of $726,200. We will require at least 6 months of reserves to pay the mortgages. And also, if you are buying an investment property, then we also going to require some reserves to at least have 6 months in the bank and in your account. You don't have to pay, so that we can see that you have enough money to cover 6 months of mortgage payments and reserves. Any questions about that?
No, I don't see anything.
Okay, the property, of course, the property, what is the market property? What's the market value of the property that you want to purchase? We take care of that by way of the appraisal. We conduct an appraisals to see what the value of the money is, because there's always realtors involved. The sales price is very much very close to, or if not, the actually appraised value. So there's not much to do about that. It's just that an appraisal has to be conducted for either refinancing transactions or purchase. The bank needs to know what the price of the property is, because we're going to base the minimum 3%. And of course, the closing costs based on the value of the appraised value of the property. Any questions?
Yes, we have two. Tiffany asks if what you mentioned applies to USDA loans as well.
What type of loans?
USDA.
The USDA is the Department of Agriculture sponsor or insure loans. It's kind of like the VA loans, in which customers could actually get 100% financing of the sales price. They still have to pay the closing costs, but the bank will actually, if the sales price of the property is $500,000, you get a $500,000 loan. I have yet to do a USDA loan myself. I've been here doing mortgages in South Florida. There's only like farming around the very south of Miami in Homestead, but I've never done a USDA loan. But that's what it is. It's kind of like a VA loan. You get 100% of the sales price lent to you, but it has its own requirements. And basically, it's got to be agricultural land. And you have to have, I believe, some type of agricultural operation going on to actually have the USDA loan approved. The interest rates are usually lower, kind of like VA loans, but that's what it is.
There's now another one that asks, what's a rule of thumb for closing costs in terms of home price or down payment?
Like I said, the estimated closing cost that I use is 4%. It's an estimated. I used to use 5%, but 5% kind of scared people, like, wow, 5%. So I use 4%, and it's somewhere in the middle. It's anywhere between 3.5 and 5% of the sales price. As far as closing costs involve a few things. Closing costs involve the lender fees in the case of a bank, which happen to be the lesser lender fees in the industry out there, is about $1,500. So $1,500 for processing the loan. The rest of the closing costs involves your insurance premium for a year. You have to pay 1 year ahead. And also, we also have to collect for an escrow account or reserves to pay the insurance next year, the same as taxes. And then the title fees are also into that closing cost picture. So when I say, for example, 4% in closing costs, and if the house is or the property is $500,000, that means that the closing costs are going to be an estimated $20,000. But of those $20,000, only $1,500 actually are lender fees. The rest, and then you do the math, you're talking about $18,500 going to go in title company fees, the insurance and the taxes, and the escrow reserve account to be able to pay the taxes the following year, and also to renew the insurance the following year. So I use the rule of thumb of 4% to estimate closing costs.
Okay, and there's one more question. Can you buy a house without working with a real estate agent?
Yes, there's quite a few transactions out there that involve the seller of the house only. So if I want to sell my house and I do not want to pay a 6% real estate or realtor commission fee, then I would just list my home as sale by owner. I actually do not recommend it unless you're a real estate savvy, I would suggest to always use a realtor. Otherwise, you'll be at the mercy of the seller for just about anything. When you get into a realtor will assist you with determining the value of the house based on the state of the house, not only how beautiful it looks, but they would take a look at the water here, at the AC, at the roof, and those are stuff that I'm pretty sure most people don't worry about when they're going to buy a house. So I would suggest to always use a realtor. I am savvy myself, but I choose to use one when I do my transactions, even if I have to pay the 6%. You could adjust the sales price if you're selling to offset that. But once again, but the answer is yes, you don't have to get a realtor involved. But I highly recommend it.
Thank you. No more
It's
questions.
Solomon, I have a question for you. You mentioned always use a realtor, but who should you have contact with first? A mortgage consultant like yourself, or engage with the realtor first? What would your recommendation be?
My recommendation, of course, would be to call a mortgage loan office, because the first thing that you're gonna hear from a realtor is, "Oh, you want to see a $500,000 house? Have you been approved for a $500,000 loan or for a $500,000 property?" That's the first thing that's gonna ask you. No realtor is gonna spend time to drive you around to see houses, not knowing what you qualify for. So that's a given. And realtors are not, in my opinion, once again, my opinion, Wells Fargo's opinion, are not the best advice to offer you mortgage advice. I think you should go to a mortgage loan officer from a bank like myself or a lender. I would suggest a bank. Why? Because you trust banks to do just about anything else with your money. It gets deposited, your salary gets deposited into a bank. You go to get a auto loan from a bank. You do all the investments to a bank, and then when it comes to the largest debt you're going to incur in your lifetime as a mortgage loan, then you go to a realtor or you go to a lender. I would suggest always get the opinion of a bank and get the opinion of a lender if you want to see the differences and compare apples to apples. In my case, over the last 2 months, Jeff, I have actually managed to get some people to choose me, because when it comes to, well, my realtor said this, or my lender said this, I said, regardless of what they say, compare the loan estimates. Once you see the numbers, you can see which option saves you more money and go with that. And once they do that, they say, Solomon, I choose you. So because of that, and I'm not telling you, like I said, don't take this for granted. Do both. Consult a lender, a mortgage lender, and consult a banker, and then compare the prices. We're talking about a lot of money. I mean, I'm using the $500,000 example with $35,000 combined of down payment and closing costs. That's a lot of money. So if what the bank is gonna cost you $35,000 and what the lender is gonna cost you 45, pay attention to that, and then choose accordingly what you think is gonna save you the most money, not anything else. When it comes to salesmanship, yes, you might choose someone because of family, or because you were recommended, or because you like that person better, whatever the case might. That's just like any other sales transaction you do. When you go to buy a TV, you take into consideration a lot of things, not just the price of the TV. You like the presentation, how you're treated, and all that. So all that comes into play. But however, what I place emphasis on, aside from providing the best customer service possible, is look at the loan estimate and make a decision on that. And most of the time, you're going to come to the bank, because we will save you money, in my opinion. Okay, if no more questions, we go into this slide. This one says 36% debt to income ratio, and the housing ratio is 28%. Basically, what it says, the house, for example, the housing to income ratio is basically the ratio of your housing payment. Say if your mortgage payment is $2,000, then that 28% is what the $2,000 represent. And the 36 will be your total debt to income ratio, which is adding that 2,000 plus your auto loan, plus your student loans. That's 36%. However, as I said before, we don't use the 36 or the 28. Those are like standard Fannie Mae and Freddie Mac standards, and FHA as well, but we use the 45 to 50%. Any questions about that?
Yes, so if we're currently not looking to buy a home, but you would like to see if you're approved for a mortgage, will doing that hurt your credit score?
In my opinion, it doesn't. I use this to kind of picture why I'm saying that. Right now, no one knows what the credit score is until it gets pulled, right? You might have an estimated credit score from Credit Karma, which comes with a date. You might have a FICO score given to you by your bank app or your bank services that also has a date, but that's an estimate. That's not a hard pull, and that could just be one credit score. It could all be Equifax or Experian, and that's what that is. When we pull credit, we pull what we call a tri-merge credit score, which will pull all three: Equifax, Experian, and TransUnion. The system, by regulation, the guideline is to pick the number in the middle, not the highest, not the lowest, not an average, the number in the middle. So whatever that number might be, that's not what you get from Credit Karma, and that's not what you get from your bank apps. So no one could ever argue that, Solomon, you said that it's not going to hurt your score. But my score this morning was 775, and now it's 750. I would ask you, how do you know it was 775? You're going to go, well, that Credit Karma tells me so. And at that point, I said, well, Credit Karma is an estimate that they gave you from one single credit bureau, and it's probably outdated. It was probably given to you 20 days ago, or whatever the case might be. What is true is that if you go to 5 banks in the same day, or you go to 5 different department stores, and I'm using that as an exaggeration, but let's say you go to 2 or 1, and then that same day you get your credit pulled, that might damage your score, because once again, it triggers an algorithm in your credit bureaus that said, oh, this person is about to spend more money, and that increases your risk and lowers your score. But there's no set rule that it says or anything to evidence that if a bank pulls your credit, it's going to lower your score. If you Google that, you will get something like, you could get 3 credit pulls within 14 days and not have your credit score affected. But once again, when it comes to credit scores, it is more an art than a science, because it fluctuates daily based on your daily balances and God knows what else. So in my opinion, no, it doesn't hurt you. But if you go to for example, a car dealership, the car dealerships have the habit of sending your information to at least 3 different financial institutions, and having your credit pulled by 3 different financial institutions, that lowers your score. How much does it lower your score? Like I said, that's also up in the air. It might be minimal, 5-10 points, or as much as 20 points. It all depends. Once again, an art more than a science, but in my opinion, to have your credit pulled for a mortgage application does not hurt your credit score at all.
And we have just one more question. Do you recommend working with a real estate attorney to help with the paperwork, or does a realtor take care of that too?
No, the realtor doesn't take care of anything like that per se. They only take care of showing you the house and getting the contract going. The only thing is that as real estate professionals, as myself, they might recommend a title company. They might recommend also a mortgage lender, in which case, like I said, yeah, sure, be open-minded, get an estimate, I have your credit pulled by that mortgage lender, but I advise you to also do it with a bank, especially one of the big banks. In this case, of course, Wells Fargo. I work for Wells Fargo. I like Wells Fargo. I've been with Wells Fargo 6 years. I would recommend that. But basically, any big bank, as Bank of America, Chase, or Citi, will be able to provide competitive rates. We all basically have the same products, charges as far as fees and interest rates. But lenders, they're a different animal. They don't have as many controls or as many compliant regulations as we do, and they could charge you $10,000 more in lender fees and be strictly legal. A bank would never do that. If we don't have a reason to charge you a dime, we will not charge you a dime. We're not going to be excessive about any of our fees. They're pretty standard, in which case, like I said, it's $1,500 for the processing of the loan. Let me see. I think I might have gone on by a tangent and forgot what the question was.
If you recommend that people work with a real estate attorney, but I think you.
The real estate attorney, like the title company works is the legal entity that's been assigned by law to actually do the closing. There's no way you cannot do that. You can do either a refinance or a purchase of a house without a title company. And they deal with the legality of the issue. They usually are either tied with a title attorney in-house, or they have a partnership with one that will help you. So there's no need for you to incur a different fee just because you want to make sure everything is legal. What I suggest is, yes, work with the standard realtor, mortgage lender, and the title company that you choose, or the seller or the realtor chooses. And if you see anything that you might not understand or trust, then by that I mean, in that instance, if you feel comfortable, you have an extra expense, then you could consult a real estate attorney. But I wouldn't suggest so. I wouldn't suggest to do so. There's no need for it. Like I said, the title company takes care of all the legality of the purchase of the property, and all the transaction, all the charges in the transaction, to make sure that everything is kosher. Part of my expression, to make sure that everything is correct and legal. So, in my opinion, no.
Okay, thank you.
Like credit basics. Credit basics are like, let me see, the credit score. It's a number between 300 and 850 that tracks your payment track record, the amounts you owe, the length of credit history. We look for credit history beyond 1 or 2 years at least. To credit and the type of credit, type of debt. Mainly, when it comes to the credit, what we look is at the monthly payments. Customers like to refer, oh, I only have $30,000 in debt. That doesn't tell me anything. What it tells me, what helps us, and what we need is actually the monthly payment you are incurring or paying in those debts. Right now, I am seeing for the first time ever, I've seen it for once every month, ever since last year, actually since December, car payments in excess of $1,000. So yes, I guess cars are getting more expensive. So now you're getting a $60,000 car at 7, 8, 9%, and your payment a month is $1,000. It's quite a bit. So that kind of works against you if you are thinking of purchasing a house. Remember that it's all about debt to income ratio. So we're going to take 50%, if not 45% of your income, and calculate that that's what you're going to use to pay all your debts, to include the mortgage payment. If you have $1,000 car payment, that kind of diminishes your borrowing power. How can you improve your credit score? I talk to folks, especially in the school and education field, that take care of your credit score like you try to take care of your GPA. Try to keep it as high as possible. The higher that you get it, the lesser the debt to income ratio will be, and you could just very much qualify instead of being declined because you have hiccups on your credit report as late payments over the last 12 months specifically, or any collection agencies, any charge-offs, any repos, foreclosures, bankruptcies. All of that kind of works against you and stops you from getting a loan, which is one of the reasons I was, this is what I was going to say when someone asked about, should we have our credit pool to do an application, even if you're not really thinking of buying right now. It is a good tool to use to make sure how healthy your credit score is, because you don't want any surprises when you think you're ready. Now you think you're ready, and now you're gonna find out that auto loan you co-signed for your brother or your dad or your mom or your other half, now that's against your debt to income ratio, and now you're not able to qualify because not only are you paying for your car, but you also, and your credit report shows that you're also paying for somebody else's car. And if that debt is lesser than 12 months, we cannot deduct that debt from you. And if you are making the payment, let's say you co-sign an auto loan for your brother, and your brother is giving you $1,000 a month, and we can see the transfer from his account to yours. But because you're the one paying for your account, it makes a difference. We cannot take that debt off your debt to income ratio, and now you don't qualify because you were being a nice brother or sister or whoever you co-signed the loan for. That's just one of the things. It could be many reasons that could stop you. And I think it's I'd say it is a golden piece of knowledge to be able to know what your buying power is based on your income and credit. So I would suggest to do it, because that's the only way to know. I have customers that beat my phone to death and want to meet me in person, and because they're so hesitant to do it. But at the end of the conversation, go, listen, there's only one way to know. Yes, we can talk, we can project what you might or might not have on your credit report, but there's only one way to know. It is free, but we don't charge you to do a pre-approval, so why not do it? Especially if you have excellent credit score, anything about 740, it's icing on the cake, so you shouldn't be hesitant, scared, or shy about getting your credit pulled for a piece of information as valuable as knowing what your buying power is when it comes to buy a house. That's my advice. How can you increase your credit score? Paying down your credit card debt or revolving debt, making bills automatic. There's a lot of people that go on vacation and forget to pay. If you have automatic payments, you will get rid of that risk. Not opening auto new accounts. We look for at least 3 trade lines, or accounts in your credit report. I've seen people with that have had a credit or whatever, and now they don't have any debt, and they still have excellent credit score above 740. So you don't actually need to always have 3 trade lines, but as long as you have a history of having accounts in the past, auto loans, mortgages, credit cards, and haven't been paid off, and now I pull your credit, you have no debt whatsoever, and you still have an excellent credit score. So it is not needed as long as you have a history. I do pay in history. If you see anything derogatory in your credit report through Credit Karma or such, or if you get the free annual reports, contact the creditors, the people that claim. And sometimes they make mistakes. Sometimes you did pay that $80 last balance on your Comcast or cable TV services, but they're saying you didn't. So you call them up and say, hey, listen, I pay you. Here's the proof. I have the check here. I have my bank record that says that I pay you those $80. Take that off the credit report. And then that way they do so, and your account would increase if you are in the right. Because sometimes they do make mistakes. Any questions?
Yes. Is the housing to income ratio based on net or gross income?
If you are salaried, it is based on gross. It means that if you are a W-2 employee, in which you get federal taxes, local taxes, Medicare, Social Security deductible, you're paying, you're a W-2 employee, we calculate gross. If you happen to be a 1099 or self-contractor, or self-employed, owner of your own business, then we calculate net as you report it on your income taxes.
I think following along the same lines, how do lenders consider irregular income, like from freelance jobs, when looking at that housing to income ratio?
We'll look at the 2-year history of your employment. We cannot count overtime, commission, or bonuses unless you have a consecutive last 2-year history of receiving either overtime, commission, or bonuses. If you are switching jobs because the nature of your work dictates so, we will take the average to make sure that your income has been consistent and there hasn't been a decrease or increase, in which case you might need to provide a letter of explanation. If your income fluctuates, and when they do, we just ask for an explanation. Why do you make $10,000 more in 2022, or why do you make $10,000 less in 2022? And then, in which case, you would answer, well, because of production, because of pandemic, because of this, because of that, because of market conditions, or because you broke your big toe and you couldn't work for 6 months. Whatever the case might be, we will ask for an explanation. But we will do the average. We do look for a 2-year steady employment with some gaps in between. Any more than 6 months, we will require an explanation. But people could be off work a month at a time, and it's not going to count against you. We do look at employment history. If you, for example, are a nurse and you have worked for 5 different hospitals in over the last 2 years, that's kind of self-explanatory. You were looking for a better paying job or whatever the case might be. But if you are working for different industries every 3, 4, 5 months, you might be deemed to risk a factor to lend to because you don't have a steady employment history. So it could hurt you as well, depending once again on the specific. Everyone is different. The best thing I could do once again is to talk to a mortgage professional as myself and deal with cases specifically. Everyone has a different financial profile when it comes to the 2-year work history, income, and credit. So it behooves you to have that conversation with a professional when the time is due.
Thank you.
The expenses you should plan for kind of self-explanatory. I was going before. You could do landscaping, you could do repairs. Repairs could be expensive nowadays. For example, the repair of a roof or to replacement of a roof is about $50,000. So a lot of people are calling me wanting to refinance cash out because they need to replace the roof. The roof was damaged by the storm, or it's now over 30 years old and they need to replace it, and they have gotten quotes, and the quotes are in excess of $50,000. And most people don't have $50,000 to just take out of the bank and say, sure, replace my roof. So now they want to finance it. So there are some expenses that you will incur while you own a house for a long period of time. So you have to take that into consideration when you buy a house, to be ready, to have some savings also, kind of like you always wanted to have 3,000, 5,000 just in case your car broke down. Well, kind of the same thing with owning a house. It is a bigger responsibility, but once again, the equity you're going to be making will offset any costs you may have in the future. We don't take this into consideration for the application. We're just advising customers, to be ready, because you don't want to go too much into debt if you don't plan ahead, kind of thing. Any questions? This is an easy slide. Basically, it says that the larger the down payment, the lower the loan, the lower the loan, the lower the payment. Basically, the interest and principal portion of the payments vary with the life of the loan. The first few years, you pay more interest than principal. And then at the end, for example, you take a look at your last payment. If you get a loan for 30 years, if you get a loan for 30 years, if you look at the amortization table, which actually dictates how much you're going to be paying in principal and interest for the next 360 months, you're going to see that the last payment is like $20 interest and $1,000 principal, kind of thing. But at the beginning is like $1,000 in interest and $20 for the principal. I'm exaggerating those values, but just kind of to make the point that the principal payment is lesser when you start paying the loan. And as you continue with the life of the loan, you pay more principal and the interest goes down. You could always pay more principal on a monthly basis to actually end up paying the loan sooner, type of thing. So that's kind of like what I like to go over when I look at the slides. Any questions?
There's one. How can I lower the interest after the fact, like once I start paying my monthly payment?
How do you lower the interest? If I understand the questions, the only way for you to lower an interest, like for example, I used today's case. I've been using the examples of the interest rate being 6.25% because they are high nowadays, the highest it's been in a few years. So if you get a loan now at 6.25 and you want to get a lower rate, you have to wait for the market to have the conditions to do so. As in 2 years ago, the rates were like 2.6 and 2.5. So you could then refinance and get that 4.5, that 6.5 interest rate to a new rate as the market dictates. So the only way to lower the interest rate is to actually refinance when the market conditions dictate so. I get customers now that go, hey, Salom, I'm thinking about refinancing. Yeah, why do you want to refinance? Well, my rate is 4.25. Well, do you know the rate now is 6.25? Oh, really? Yeah. So does it make any sense? That's right, sir. Oh, ma'am, doesn't make any sense. So then that kind of ends that inquiry right there. Did that answer that question?
Yes, thank you.
Okay. Let's see. You do not need 20% down to buy a home, 20% down payment. Right now, we have the program with 3% down. That's the minimum. With putting 20% down, what it does is it avoids mortgage insurance premium. But you can put as much down as you are able to do so, minimum of 3% and 3.5 for FHA. So you do not need 20%. That's a misconception that conventional lending, you need 20% as opposed to FHA, which is 3.5. You could get a conventional loan also with 3% down. So that's kind of to ease that misconception that still today, even people in the bank think that, oh, I need 20% to buy a house. No, you don't. Any questions?
I have a question. If you do less than the 20%, at what, is there a point that you stop paying that mortgage insurance? Or does it just go on through the
Yes,
life?
the rule as it goes now, Patricia, is that you would stop paying once the balance on your loan reaches 80 or actually 78% of the original price. So after you've been paying your mortgage for 5-6 years, and now your balance is 78% of the original price, it will go off automatically.
Thank you.
Now I did a pre-approval or an estimate the other day in which putting 10% down with the credit score that the client had, there was no MI or mortgage insurance. So once again, it all depends on your credit score, the loan amount, and how much you're putting down. But with 10%, I was quoting this customer who was going to purchase a $350,000 house or property, and then he was putting 10% down, and lo and behold, the mortgage insurance did not pop up. That's just a new change that came about recently.
Okay, thank you.
How can you save more money for down payment? Pay yourself first, spend less, save more. That means go to Walmart, create a spending plan. You could track that. But what I was going to say about paying yourself first is I calculate for the same house you are renting, or for the same size you are renting, the same property, you should at least save 1 year of rent. So if you're paying $2,000 in rent, that's, I believe, $24,000 a year. You should have at least that much saved if you want to get into a house or an apartment about the same size. So at least 1 month of rental should be able to get you what you need to get started, at least with the minimum. Once again, the 3% down and the calculated 4% in closing costs. Options available for loans. We've got the fixed rate mortgages. We've got the adjustable rates that I said that I was doing when I was in the Army, because I was moving here and there every 4 or 5 years. So I will get an adjustable rate mortgages. The rates are low for the first 5, 7, or 10. By that I means that you could either get an ARM or an adjustable rate mortgage, 5 years. They're called a 5/6 or 7/6 or 10/6. 6, and what that means is the first number tells you the amount of the the amount of years that the rate is going to be fixed, and then after that it's going to be variable, and depending on the market conditions, that could really work against you. So I would always advise to get the fixed, unless you know for sure that you're going to be moving before it matures to be a flexible or adjustable rate. FHA loans, the Federal Housing Administration loans, is a federally insured loan and incurs an additional cost to the that gets added to the loan by the amount of 1.75% of the loan amount. It is called upfront mortgage insurance premium. So because of that, it ends up being a little bit more expensive because you end up borrowing more money. And you also, unless you put 10% down, you're going to have mortgage insurance for the life of the loan, as opposed to the conventional loan scheme that I was talking about before, in which I was saying that 5-6 years, when the balance of your loan reaches 78% of the original value, then it goes away. With an FHA loan, unless you put 10% down, the FHA mortgage insurance premium is going to stay for the life of the loan. So that's why I always advise to get a conventional instead of a FHA. I only do FHA when the conventional loan is not approved by the application software. Then I have to flip it literally to an FHA loan so it could approve it. FHA loan is more lenient when it comes to credit history hiccups than conventional. So conventional tends to be a little bit more strict when it comes to credit payment history. FHA, you pay a little bit more, but it will get you the loan. The VA loan, as I mentioned before, kind of like the USDA loan, is 100% off an option. It doesn't have to be 100% of the sales price you could get lent by the banks. So that's what that is. I am a veteran myself, but I don't know if I mentioned that I was in the Army 20 years, 1 month and 2 days. So I'm a veteran, so I could actually do that. And I have done that in the past. And I think, as a matter of fact, this loan for this house was also a VA loan. Even though I put some money down, it was still a VA loan, and I got a lesser rate than conventional or FHA. Jumbo loans are any loans in excess as of this year of 726,100. Last year was like 587, so it kind of goes up every year, but that's what it is now. They have different conditions because they are basically financed by the bank's portfolio or the bank's money, as opposed to being conventional with Freddie Mac or Fannie Mae, which gets sold on what we call the secondary market. Jumbo loans are actually kept in the bank's portfolio. They have different conditions, and it's for larger amounts. The interest rate sometimes is lesser, sometimes it's more than conventional. Right now, it's just about the same. Depending on how the market is, they could actually be lower and such. Loans for newly built homes. We have new construction loans, but new construction for like developers. There is no loans for like if you have an empty lot, or if you want to buy an empty lot, could the bank lend you to build a house? We don't have those anymore. Newly built homes. So like I said, it refers to developers as Lennar or any developer per se. Sometimes they just have smaller developers that make one house at a time, and you could get into that deal with the projected date of being finished or completed next year, and we could actually give you the pre-approval. We could lock the rate a year out to today's market conditions, so that's very convenient, especially for a bank of Wells Fargo that could actually lock the rate as much as 2 years out. Any questions?
Do VA loans typically offer lower interest rates than FHA loans?
Yes, for the most part, yes.
And if you wanted to build a home, how would you go about getting a loan for that?
You don't. There's no construction loans. Like I said, if you have an empty lot or you want to buy an empty lot to have a bank lend you money to build a house, there's no bank products for that now. Some lenders might have it, but like I said, we had one about 6 years ago when I first started working with Wells Fargo. They did without it within a year. I never did one myself, but they ended that project. So no, the house has to already be built and livable in order for you to get a loan. How do you know how much you could borrow? Like I said, I encourage anyone and everyone listening or attending this presentation to do so if you really want to know. Like I said, you could Google, you could do this, you could do that, but there's only one way to know. It is by collecting your income information in the application and pulling your credit, and then you really know. That information is really crucial, really important. So I highly suggest it. It is free. We're not going to charge you anything. So I suggest you do it. That's what a pre-qualification is. Pre-qualification, if any of you call me later, say, Solomon, without pulling my credit, could we go with this? You know, this is what I owe. And I could actually open my computer and do a pre-qualification application without pulling credit and taking your information as to, yes, your car payment is $550. Your credit card payment is $200 a month. And such, and what will be, and I make this much money, what will be the maximum loan amount? And I could tell you, and I could even print something and send it to you. But is that worth the paper it's printed on? Most likely not, because once again, the only way to do it is to get the priority buyer or pre-approval, in which we actually pull credit, collect your credit information, even though the caveat is that we are not required to ask for any documentation to give you pre-approval. That's kind of to keep in compliance with federal regulations as in the aspect of equal opportunity. I cannot tell you, well, if you don't show me your W-2s, your pay stubs, you're not going to get one. No, I have to. If you call me over the phone and I have the time to do the pre-approval, or you visit me at the bank and I have the time to do the pre-approval, you can sit in front of me and tell me, Solomon, I'll make $100,000 a year. That's all I'm going to tell you. Give me a pre-approval, and I have to by federal regulations and bank regulations. However, is that going to be worth the paper it's printed on? No, in my opinion. So my opinion is give me your precise income information. let's have your credit pulled, then you really know. And now you could go later to the bank or to the realtor with, hey, I've been pre-approved for $500,000 by Wells Fargo, by this guy named Solomon Consuegra. Show me some properties. So that's where your money is, and that's where you get the most value in this process. But once again, if you know for a fact that your credit is not 620, or for any reason you don't want to have your credit pulled, by all means, yes, we could establish the conversation. I could give you a pre-qualification based on your hearsay, and see, if that helps you to plan, which I'm pretty sure it will. But if you want to know for a fact, and you want to know for sure what your buying potential and your borrowing potential is, have the pre-approval, have your credit pulled if you can afford to do so. Any questions?
No, thank you.
Okay, the home financing process, basically, and I think this is one of the final slides. I'm going as fast as possible. But I hope you guys are comprehending everything that I'm saying. Completing the application, we have what we call an OMA or OMA, online mortgage application. You can fill it out on your phone, tablet, PC, or Mac. It takes about 20 minutes, in which we will collect your residential and work history for 2 years, where you have your money, collect your income information, pull credit, and then we give you the pre-approval and such. The financial and property review, once again, the financial review deals with the review on the application. The property deals with the appraisal. Once we have, basically the way it works, you call me, you get a pre-approval, you go look for a house, you like the house, you make an offer, the offer gets accepted. Now you come to me with the executed sales contract signed by you and the seller of buying that property. Then we will review that. We will review now the documents are required. Now, remember that I said that for a pre-approval, I don't need by regulations to see your income information or any information in black and white. Now we do. Now we need the underwriter of the bank who is going to approve that $500,000 check that they're going to send to, or wire that they're going to send to the title company, so they can provide that to the seller. There's going to be a very thorough and extensive review of your financials of the property, through the insurance, through the appraisal, and all of that. And then once we have all that, and we know that your financials check and that the property check, now we get ready to prepare to close. And then all you have to do, of course, is attend the closing. You go there, you wire the amount of money that you're gonna need for your down payment and closing costs to the title company. And the seller gets the wire from the title company that they got from the bank. And now you get the keys to the house, and then you have that warm handshake in the bottom. And that's the end of your closing with the bank. However, there will always be questions. In about a month or two, you're gonna get your first invoice bill, either online or whatever the case might be, for your mortgage. And if you have any questions whatsoever, do call me. Of course, I'm still available. Within the next year, you would also have some questions when your mortgage payments might change because of your taxes were changed or your insurance changed. So you're gonna call me because now your escrow or reserves requirements increase. Instead of paying $500 for taxes and insurance, now it's going to be $600. So now your payment is going to be $2,100 instead of $2,000. Yeah, you're going to call me, and I welcome those calls, because I could just easily explain. Yes, no, the mortgage payment is not changing. The principal and interest is not changing. What is changing is your insurance and taxes portion of the mortgage payment if you are escrowing. So, like I said, we are always available to consult with you all throughout your mortgage process. Any questions?
No, we're good.
Okay. What should you do during the loan process? Provide accurate information. Once again, it's all going to be verified by the underwriting and processing department. Please do, yes, return calls promptly, especially emails. If you request something, try to be as swift as possible. Get the homeowner's insurance quotes and the home inspection. Once you find, one of the conditions of the contract is that you have to conduct an inspection within the 7 days of signing the contract. And that inspection is what the insurance agent is going to require to actually come up with a premium price or for your insurance policy. So that's very much needed. You don't pay that to the bank. You pay that with your home inspector, wherever you get the home inspection from, recommended by me or the realtor, or whoever you know that will do the inspection, but two here in Florida, they're gonna ask for two inspection reports. The wind mitigation report and the 4-point or structural inspection report. And that's what the insurance is gonna use to base how much you're gonna charge you for your yearly hazard insurance. And maintain your credit. Like I said, try to keep it above 700 if you can, or the maximum possible. Treat it like your GPA, treat it like gold. Be very careful when you switch accounts with cell phone providers or any type of utilities, as well as medical bills, because for some reason, medical bills, your insurance didn't pay a copayment of $80, and the only way you're gonna find out is when I pull your credit and I go, hey, listen, your credit is 619 because you have an $80 medical fee that apparently you didn't pay. And very little information can be provided because it's medical, is protected by the HIPAA federal regulations. So be very careful when it comes to credit. Try to get a free credit report yearly. Get in the habit of calling Equifax, Experian, or TransUnion and get a yearly free report that will tell you what you owe and what outstanding debts you have or anything derogatory in your credit. It will not give you the credit score, but it will give you the credit history for the last 7 to 10 years. Very valuable information. How can I assist you? Well, lending leader Wells Fargo is actually the second largest bank in the U.S. right now, and the largest mortgage lender. I'm here to help you to understand all the options. Like I said, as fast as I went and I try to go, there's a lot there. I talk about this every day, which is probably explains my pace. But if you have any questions whatsoever, I believe you're gonna be provided with a copy of this presentation and my contact information, cell phone, email, and along with some links with valuable information. If you actually write me an email, I will reply, and on my signature block, you have tools that you could calculate a mortgage payment and then project that way. And if you have any questions, by all means, do call me. We want you to stay informed. We want you to know what your options are. So please call me. I love what I do. That's me right there with my websites that go directly into my profile with the mortgage calculators, and even to apply online for my link. Any questions?
I don't see any questions. I have posted the link on the chat where this presentation and all those links will be uploaded. So if anybody wants to reference that, just make a note of that URL right there.
Okay. See, I'm trying to open something else here. It's a message from Jeff. So, Patricia, Jeff, attendees, I am here. I don't know how, I don't know if we were actually allocated 1 hour. We went a little bit over that. There's a lot of material to cover on these slides. I apologize if I went over a little too fast. But once again, I love what I do. I'm always available. I always answer my cell phone and my emails constantly. I'm addicted to my iPhone just like everybody else on the planet. So please use that to your advantage. Once again, it's to your advantage, so you are informed. I am happy to provide any of this information anytime.
Okay, well, thank you, Solomon, again for joining us today and for all the valuable information.